The U.S. markets are currently closed for the weekend. The closing price for Rezolve AI PLC, ticker RZLV, on Friday, October 24, 2025, was $4.72 per share. That figure represented a significant move, finishing the day up $0.28 or 6.31%. Now, seeing a 6% pop on a tech stock with AI in its name is the kind of thing that gets a lot of attention, especially on retail-focused investing sites. The immediate expectation is that this is another validation of the AI boom, that RZLV is on its way, and that this $4.72 stock is just a stepping stone to the $10 or $15 price target some analysts have put on it. But the reality of today's market action is far more complex and, frankly, far more dangerous than that simple narrative suggests. The 6% move we just saw is less about a fundamental validation of their business model and more about the brutal mechanics of a highly speculative, high retail interest post-SPAC stock that is caught in a violent tug-of-war between a very promotional management team and a very skeptical short-selling contingent. This isn't the slow, steady accumulation you see in Apple stock. This is a knife fight in a phone booth, and Friday's 6% jump was just one side landing a blow. The common belief, the story you'll see pushed in press releases and on social media, is that Rezolve AI is an undiscovered gem. The narrative is that this company is building the essential backbone for Agentic Commerce, using its proprietary brainpowa large language model to create an entirely new AI-driven shopping experience. The company has been on an absolute tear with announcements, touting strategic acquisitions like Subsquid and SmartPay to build an end-to-end platform that combines decentralized data with AI and digital asset payment rails. They've highlighted partnerships with giants like Microsoft and Google. They've even issued astonishingly bullish guidance, projecting an exit rate of $150 million in annual recurring revenue for 2025 and a massive $500 million for 2026. When you hear that, and then you see analyst ratings pegging this as a strong buy, the expectation is that you found the next Nvidia stock before anyone else, and you're getting in on the ground floor. It's the ultimate online investment dream. But then there is the reality, and it is a stark contrast. The reality is found in their financial filings. For the most recently reported quarter, Rezolve AI posted revenues of just $3.16 million. On that $3.16 million in sales, they reported a net loss of $28.93 million. That is not a typo. Their net profit margin is negative 915%. They are burning through an astronomical amount of cash to generate a tiny fraction of it in revenue. This isn't a growth story, it's a survival story. The second and perhaps more critical piece of reality is dilution. Over the last year, the total number of outstanding shares has grown by nearly 75%. This means that even if the company's value grows, an individual shareholder's piece of that pie is being systematically shrunk. This is the classic, unfortunate pattern of many companies that come public via a SPAC, or special purpose acquisition company. They enter the market with grand projections and a high valuation, but the need for actual operating cash forces them to sell new shares again and again, crushing the very investors who believed the initial story. This is a world away from the stable, long-term compounding you might see from Fidelity mutual funds or a managed Schwab Intelligent Portfolios account. So, let's look at Friday's 6.31% pop through that lens. The stock traded over 10 million shares, which is heavy, but still below its 30-day average of over 27 million. This stock lives on high volume. Why? Because it's a battleground. On one side, you have the company's aggressive PR, the analyst ratings, and the retail traders on platforms like the Robinhood app or SoFi Invest, who are buying the 500 million ARR story. On the other side, you have a very active short seller contingent. In fact, the company recently had to issue a press release to publicly refute a negative report from a short seller named Fuzzy Panda. When you have this much retail interest, the general public owns over 41% of the company. Colliding with a dedicated short position, you don't get stable price discovery. You get extreme volatility. That 6% pop could easily have been a small-scale short squeeze, or a wave of momentum trading, or just noise. It could be erased in the first 10 minutes of the next trading session. This is what makes it so different from a move in a mega cap like Tesla stock, where a 6% move involves tens of billions of dollars changing hands based on a more fundamental consensus. For RZLV, a 6% move is just another day. What's fascinating is the institutional sponsorship, or lack of. The company's press releases have celebrated reaching 10% institutional ownership as a major milestone, citing names like BlackRock and Vanguard. But the reality here is more nuanced. RZLV was recently added to the Russell 2000 and 30,000 indices. When that happens, any index fund or Fidelity ETF that tracks those indices is forced to buy the stock. This is passive, automatic buying. It is not a sign of active, high-conviction investment from a Fidelity wealth management advisor. The actual high-conviction institutional money is largely sitting on the sidelines, likely waiting to see if that $3 million in revenue can ever get close to covering that $29 million loss. The sophisticated traders using platforms like interactive brokers are likely playing the volatility, not building a long-term position. They understand the risk. This isn't an investment help seminar, it's a high-stakes bet. People using SoFi Active Investing or Robinhood stock trading tools need to understand that they are not buying a cheap AI stock, they are buying a lottery ticket on a highly ambitious, cash-incinerating corporate strategy. So what is that strategy? What does Rezolve AI actually do? The company came public in August 2024 through a SPAC deal with Armada Acquisition Corp. I. Its core idea is to change mobile commerce. Instead of you searching for a product, their technology is designed to let the world be the search. You might see a product in a TV show, point your phone at it, and be taken to a checkout page. Or you might interact with a brain assistant to complete a purchase. To achieve this, they are on an acquisition spree. They bought GroupBuy for product discovery, SmartPay to handle digital asset payments like stablecoins, and Subsquid to manage decentralized data. Their plan is to stitch all of this together into a single Agentic Commerce platform, powered by their own brainpowa LLM, which they can then sell to retailers. It is incredibly ambitious. They are trying to build an entire ecosystem from scratch, one that competes with everything from QR codes to Apple Pay to Amazon's entire checkout process. This brings us to the future outlook, and the tension between expectation and reality becomes a chasm. The bullish expectation is simple. They're right. The expectation is that the 500 million ARR guidance is not a dream, but a forecast. It's a bet that their brainpowa platform is genuinely superior, that their partnerships with Microsoft and Google will convert into billions in gross merchandise value, and that their recent acquisitions will integrate seamlessly. If this happens, $4.72 is an absurdly low price, and the analyst targets of $10, $12, or $15 a share might even be conservative. In this scenario, the cash burn is just a temporary cost of acquisition, and the dilution will stop as the company becomes self-funding. The reality, however, presents a much grimmer set of possibilities. The primary risk is execution and cash. They are trying to do too much too fast. Integrating 3 separate complex companies, GroupBuy, SmartPay, SubSquid, into one coherent platform is a monumental task, all while trying to build out a new brainpowa LLM and sell it to major enterprises. The much more likely scenario is that the cash burn continues. That $29 million loss per quarter is a ticking clock. Based on their last balance sheet, they do not have years of cash. They will almost certainly have to raise more capital. And how will they do that? By selling more shares. This is where the 75% dilution of the past year becomes so terrifying. If the market loses faith in the 500 million story, the stock price will fall. The company will then have to sell even more shares at even lower prices to raise the same amount of cash, accelerating the dilution and creating a post-SPAC death spiral from which few companies recover. The 52-week low of $1.07 is a chilling reminder of where this stock can go if the narrative breaks. This is why you don't use your Fidelity IRAs for this kind of play. This is a speculative position for an individual brokerage account, taken with the full knowledge that it could go to zero. This is a classic story stock versus balance sheet conflict.